All right, friends. So today marks the final episode of the Delta series, and I want to wrap things up by reviewing what we covered so far. So we talked about the significance of the Delta and how it impacts your option premiums and how to approach it from a probability perspective. Okay. We also talked about the importance of the 50 Delta and the 25 Delta for both the calls and the puts and its implications. All right. So remember, the 50 Delta is typically at the money. 25 delta is expect to move from the current price that it's currently at that given expiration date. And so in this episode, I want to dive into how to evaluate the future expected price of a stock using what we've already learned. And so in hopes that this will help you make better decisions when you're trading stocks, options, or leaps, whether it's short term or long term. All right. So let's start by revisiting the key point from the last video, the last episode about the expected move and how the 50 delta typically represents at the money contract. But today we're gonna examine MU, okay, Micron, which has earnings coming up this week. And today's as of right now, the option chain shows something really interesting. And this usually you'll typically see this in earnings, some maybe huge news event for that given stock, or further out expirations. Okay, so you got to pay attention to this. So on MU, the 50 delta is not at the money. Okay, the 50 delta is right here between 111 and 112. This point 50-20 doesn't count. I'm talking about 50 flat. All right, so somewhere between 111 and 112. And so this is slightly out of the money, right? 2, 3 strikes out. And so what this indicates is the delta is right now indicating a bullish bias towards the call side, right? When the 50 delta, this is what you have to pay attention to. When the 50 delta is out of the money, it suggests that the market is favoring that one direction, whether it's on the calls or the puts. Especially for short-term expirations, this is a pretty significant thing, okay? Because you're only see this in typically further out expirations, months, quarterly expirations, and definitely leap expirations. This is how I'm able to figure out if there's a big expected growth on a stock from now to a certain year or to a certain point, to a certain expiration. Okay, and so let's take a look at a longer expiration. We'll look at January 2026 contracts. Okay, and let's say I want to have a long thesis on MU because I like the stock, I like the growth, but I want to see what's the expected here. So for longer expirations, again, this 50 delta significance of it being out of the money is even more relevant, right? So again, let's suppose that I want to get into MU and I want to the way I want to figure this out is I want to figure out where's point A and where's point B. Point A being right now, and then point B being like what's the future price, the expected move, right? And what I want to do is figure out that map. And the way I do that is that I like to go out a year long in the stock, and then I want to see where is the 50 delta. Is it far out the money? Because if it is, that signals an expectation of the significant move to be even greater, right? And so right now, the 50 delta for MU is far out of the money on the call side, right? 64, 61, 57, 54, 51, 48. Okay, so right now, the 50 delta is somewhere between 130 and 135. That tells me that this is a big expected move. Now, the next question is where's the 25 delta? Because remember, the 25 delta tells us reflects the expected move from the current price to that given expiration date, right? So in this case, if we go out, where's the 25 delta? It's somewhere between 185 and 190. And so that is about an $80 point move from where it's currently at. That to me is a great risk to reward ratio. If I want to go long on shares or an option leap out in January 2026, this is a great expected move or a great risk to reward ratio, right? You have a lot of upside potential because the delta is already telling us that right off the bat. And so by doing this, you're building a framework to let the delta guide your trades, making sure that you have potential growth or that there's some sort of volatility. Okay, let's take a look at another one is Nvidia. Nvidia during the huge massive run up, it was just like what we saw, but even greater. That's why it had huge. When Nvidia was running up, I was so bullish on it because the deltas alone were telling us. You can see here with Nvidia, look how far the 50 delta is. It is right now it's sitting at 130. The 50 delta is somewhere around 158 and 168. So the question is like, where's the 25 delta? And if I look at all of them, all the expirations, I don't even think it shows up here. Let's see where it's at. Oh, it does. Okay, awesome. So it's somewhere between 227 and 230. So if you think you missed the boat on Nvidia, you didn't. Okay, in the long run, by next year, there's a high probability based on the deltas alone that this stock is going to go from 130 to 230. That's a 100-point move on the stock alone, which is a significant return. Okay, very, very big. So again, this is the significance of using the deltas in your everyday trading, whether it's stocks or options. Let the deltas guide you on the potential move for the stock. Okay. And so that's it for this Delta series video. I hope this was informative, and I hope this helps you uh, create a map, right, to kind of give you that framework of like, this is where the highs or the potential stock can go. All right. All right. If you have any questions, feel free to ask in the comments down below, and I will get back to you. All right. Thanks.